Thank you. Good morning, good afternoon, good evening. My name is Sanjay Vatsa, and we have this session for the next 2 hours for the Private Markets 4.0. I've got an esteemed panel, and since we are starting late, I'll just introduce them briefly. So this session has been put together with TI New York, working with the TI TGS Global Summit. And the session is about Private Markets 4.0. I put down the logos of all the individuals. You've got the TI on the top, but all the companies and the speakers and their companies as to who have helped us to set this session together. And we need to give them a heavy recognition because these are experts from these companies who are running these companies who actually know about Private Markets 4.0 and the disruption coming in the space. So what we have out here is the people who are speaking on it, and I'll run through it very fast. And I think it's been advertised before, but I'm Sanjay Vatsa. I'm the Chief Revenue Officer and Chairman of Invenium Advisory Board. Also a participant in TI Women. Mark Borges is the Vice Chair of Profit Equity and also is one of the executive team members of Invenium. His fame is that he has raised over $300 billion in private equity. I know numbers matter, so I just wanted to put that number out. Dharti Desai, we're going to forego her introduction, but she is the chairperson, president of TI New York, and she's also the vice chairman of TI Women. And under her leadership, we have been able to achieve some really good, talented women coming together in Dubai to compete for a $100,000 prize money. Daniel Gold and Aditya Menon will be representing TallyX. Daniel Gold is the ex-Goldman Sachs executive, but he was also the deputy CEO at Anglo Gulf Trade Bank. Aditya Menon is the CEO of TallyX. Between the both of them, they're probably one of the leading handful of people, two of the handful of people who are actually experts in the supply chain financing capability and probably have helped and touched every deep tier supply chain financing company that has been done. So they will be presenting their use case on supply chain financing. Scott Kalowski, founder of Future Point of View, a thought leader, a person who speaks at various events, on leadership events and everything else, wrote the book, Did Crowd Create the Internet? And I think his fame is that he's trying to understand how technology could be made better or could be made useful for humankind and also balance it between human social elements, human elements and technology. He's an inventor of Humology, and we'll touch on that briefly. We got Kelly, who is the CEO of Forge Global. They just acquired SharePost and they merged it together. It's probably the best platform that you have in the world as it relates to secondary market trading for private assets. And he'll explain how it works and everything else. Patrick O'Mara is the CEO of Invenium, an investment banker over 25, 30 years, starting with Bear Stearns and other industries. And he's been an entrepreneur, a serial entrepreneur. I think this is his third entity that he started. And David Weil, CEO of Weil & Co., investment banking firm, ex-chairman of NASDAQ, but also father of Jobs Act. I think he has been very instrumental in understanding on how the full aspect of Reg D and all those elements as it relates to Job Act works. So I'll just touch on two things, and I'll touch on the aspect of Humology, which is what the basis of our discussion today is. Humology is something that has been patented by FPOV, and it's Scott brainchild thing. It's blending of humans and technology. And we're talking about private markets here. For private markets to really succeed, and not getting into a lot of details, is we have to be in the session, we have to be between T2 and T4. So I think we need a lot of technology that can enable the private markets to work so that trust and transparency can be created. So things like blockchain, AI, RPA, knowledgeable human are very essential. Public markets today are semi-automated, mostly manual, and the inefficiencies of the public markets cannot be actually acceptable in the private market side. So when we touch today, we'll talk a lot about blockchain, AI, RPA, and why that is so essential for private markets. This is our agenda. We will go through it I just don't want to highlight it too much, but I think we'll start with Kelly on the private markets, what the current trends are. And Mark, if you don't mind, I'll get Scott to speak on foundational and blockchain, and then we'll move to you. And then we'll follow the regular pattern of doing it, because we have got some speakers who may be leaving earlier as they've got other commitments. $250 trillion worth of public or private assets that can be tokenized. That we are talking about is the opportunity size in our industry. And the other opportunity is the unlocking this private security for mass affluent and retail investors. So how do you do that? How do you ensure liquidity? How do you ensure financial inclusivity is the key, and it's the key of every government. So with that, I will stop sharing, and I'll turn over the presentation to Kelly. Kelly, you're good to go.
Great, thank you. Do I need to actually screen share
yes,
myself?
You can screen share, or if you want, I can put your presentation up.
How should we do that?
No, just do it. You have it through Prezi, so just do it that way.
Kelly, do you want me to put your presentation up?
No, I don't need it. I got it. I'm sorry. Listen, let me just start off by saying thank you all for attending. It's a pleasure to present to you today. A quick snapshot on myself and Forge. As Sanjay pointed out, we consider ourselves the leading private market trading platform. We sort of refer to ourselves as the operating system for the private market. And I'll talk a little bit about the state of the private market. As Sanjay pointed out, we see our sort of mission in life is to create data, technology, and automation and efficiency for the private market. And so the operating system, as we see it, as I represent here, includes a range of services beyond the platform. But as the platform goes, we've been around for about 6 years. We've done somewhere in the neighborhood of 16,000 transactions, a little under $9 billion worth of trade volume. And in the last couple of years, this has exploded. Our investor base includes a global set of strategic financial investors. You'll recognize some of the names here on the screen: TD Ameritrade, Deutsche Börse, BNP Paribas, and a number of leading venture capital firms. We've traded primarily at the top end of the market. This is an incredible period of time for the private markets. I'm going to provide some data and stats here in a second. But over the course of the last few years, we've traded in about 350 companies, primarily unicorns. We'll talk about some of those trends as we go through here. But really, this is about allowing entrepreneurs to control their destiny. The capital markets for the private world has really evolved, and I'm going to show you some data here as we go through. Obviously, it's huge. If you look at the broader private market and just reduce it down to tech companies, the unicorn space today is about 504 global companies with a total valuation of about 1.6 trillion. Companies are staying private for a lot longer, about 50% longer than they were even 5 years ago. And if you go back to 2010, companies were private on average for about 6 years there in that time frame. So really a dramatic shift. And there are some reasons for that. Part of that has to do with just access to capital and the attractiveness of being able to grow and create game-changing businesses without the regulatory burden of being a public company. And so this trend has largely been driven by what you see here, which is the access to capital. Now, this is a US statistic. I think this snapshot applies to the global market of unicorns. A little less than half of the global unicorns are US based. And so the world has really followed the US trend here. And so the fundamental data that we're showing here is just the level of capital and valuation that you're seeing expanding over the last few years in the private markets. So this has really created the emergence of the concept of the large cap private companies. And what you see here are a bunch of names that you know. DoorDash obviously went public yesterday. Airbnb is going this week. There are over 80 companies now in the world that if they were public, they would be a large cap, Russell large cap company with valuations of greater than 4 billion. And you see firms like Airbnb targeting a valuation of 42 billion. SpaceX has got an astronomical private valuation as well. And one of the questions I get a lot is, are these trends sustainable? Are companies going public? Do we just have a set of companies that have been staying private, and as they go public, that you're going to see this trend shift? You know, this next slide here gives you a little bit of recent data. Just in the last 2 months, we've created a new or minted 18 new unicorns. And so if you think about the velocity with which some of these companies are becoming unicorns in the world, it's clear that a company like Dialpad, for example, is 18 years old. And so this is a trend that I think you're going to see for several years ahead. This bottom slide tells you essentially how many companies are going public, how many tech companies are going public over the last 5 to 10 years. And you can see that the number of companies that are exiting through IPOs relative to the number of new unicorns minted really creates the phenomenon that we're talking about here. And that we think is here to stay. Even with the kind of IPOs that we've seen in the last few quarters, this trend is obviously is here to stay. I know we're limited on time. I do want to talk about the investor side of the world a little bit here. This is a slide that represents all IPOs in the last 2 years that were traded in the private market on Forge. And what you see here, and one of the trends that public market investors have seen, is a narrowing and a contraction of public market returns. And with the slowing of new IPOs, it shouldn't be a surprise to anyone that companies and investors are looking at pre-IPO entry points. And so one of the data points that we show across our trend line here is that the returns in the S&P and even the IPO ETF that we highlight here from Renaissance have returned, in the 20 to 30% respectively in the last year, and in the last 2 years, somewhere between -7 and 30%. If you had invested in all of these companies on the IPO, then you see the kind of return that we show here in the slide. And if you had invested in the previous round in all of these companies before their IPO, you'd be looking at 1,027% return aggregate across all of these. So it's no wonder that you're going to see a tremendous interest emerge in this asset class. And obviously, we're trying to build technology and essentially make this efficient around data and access. One of the things that I'll close with here is this is not a market that has just been participated in by the venture capital community. There's really a huge revolution of democratization and a trend towards high net worth individuals, family offices, and a broader set of investors that are equipped with data and the efficiency of a platform to get in and out of this asset class. And I think you're going to see that trend continue. The kind of volumes we're seeing and the scope and size of this market is enormous. Our company is also a custodian and a data service provider. And so we have over 1 million investors now in our custodian, and about 500,000 investors that have signed on to the platform. And the range and diversity of these looks to go from what you'd see in the venture world, but also into hedge funds, global families, individuals, and we can hope to continue to promote that trend and see it continue as we go forward. So with that, I will turn it back over to Sanjay. Thank you.
Thank you so much, Kelly. I think what you have achieved is amazing as Forge Global, but what's more interesting is that the liquidity in private markets prior to it going public is very essential, and hence people can then optimize when they should go public and what is the right road for them. I think one of the aspects that we will cover later on is, okay, how do we create transparency and valuation of the underlying assets, which could further inform the person as to the performance of the asset, and we'll talk a little bit about it. Thank you so much, Kelly, for participating. I know you have a board meeting, and thank you for taking the time to help us in this session. Appreciate it. Appreciate your kind words. I think, Mark, do you mind if I have Scott go in and then we can follow up with Mark? Because what Mark has to build on, Kelly, it will build on what Kelly has said. So Scott, would you, do you mind going in first? So I know you've got a hard stop in about 25 minutes.
Sure, that would be great. And for those of you who are watching, Sanjay is assembling a story with each one of us. So Kelly started the story talking about some asset classes and some opportunities to be able to generate wealth. Kelly started the story. I have the second piece of the story, and then Mark will carry it on. So in my piece of the story, I just want to update people on blockchain as a platform. You know, for most of you, you've probably heard of the Gartner hype cycle. And if you're familiar with the Gartner hype cycle, you know, technologies are invented and then they get overly hyped, and then they drop into the valley of despair, and then they come up to a plateau of productivity. And blockchain is one that is following that Gartner hype cycle pretty closely, which is kind of interesting. Now, our company, Future Point of View, what we get paid to do is to study technologies and help clients understand where they should be investing, how they should be investing in different technologies. So Sanjay just asked me to make some comments about blockchain as a platform, because there's going to be people coming after me who tell more of the story about how to leverage blockchain. So I'm just talking about it generically for you. So if we set aside the Gartner hype cycle and the fact that blockchain kind of, it got off the radar over the last year and it wasn't talked about nearly as much as it was the couple years before, we tend to look at things as not so much the Gartner hype cycle, but if a technology is going to stay around, what does the innovation curve look like? And so for us, you know, there's something is invented, and then there's some early development work that's done, and then, you know, the value is confirmed, and then there starts to be early adoption, right? And then we go all the way up to, you know, looking at the fact that a technology becomes a competitive necessity. In other words, you have to use it. And so when we chart blockchain on this kind of innovation curve, you know, we say, all right, well, it's pretty much up to here, right? We have some widening functionality now, and it's moving towards more and more vendor options. This is right where blockchain is today, right? Between those two areas, more and more functionality being built into blockchain platforms, more and more vendors starting to offer options. But the important thing that we do is we kind of look at it and we say, all right, well, where are we with market usage? So if this is where the technology is as far as what it could be doing, and what we still see is that blockchain's got a little bit of room to run before the innovation curve starts to flatten. Not that there's no innovation anymore, just that the innovation curve flattens, right? We still have some ways to go before that. But if we look at market usage, what we find out is we're still down just past early adoption. And so as a technology, what that tells us is that blockchain has, you know, a good thing, what we would call as an opportunity gap. It's a gap between how people are utilizing a technology as a platform and what they could be doing. And so we see a clear opportunity gap right now, and meaning there are a number of financial services organizations or a number of financial markets that could be leveraging blockchain quite a bit more than they are. Now, this gap is typically driven right now by a lack of trust. You know, people don't completely trust blockchain because when it first came out, it was just supporting Bitcoin. cryptocurrencies, and some people haven't made the mental leap that there's so much more now that blockchain is doing. Their thinking is still stuck in the cryptocurrency days. So that's one issue, is just the trust in the financial markets that they can depend on blockchain as a platform. And then the second thing is just the decentralized aspect of blockchain. Blockchain, it can be private, it can be public, but it is a decentralized tool for being able to memorialize an asset, a contract, whatever it is that we want to memorialize. And so there is an opportunity gap, which is good news if you're trying to be out in front of the rest of the world. Now, when it comes to, kind of trusting the platform, I guess I just wanted to point this out real quick to everybody. There are case studies across a number of different industries where blockchain is working extremely well. That's why we say that it's coming out of the valley of despair on the hype cycle, right, up into the plateau of productivity. And so I just picked out, just some different industries, some random real uses of blockchain that are working really well. Like in the insurance space, I love what Interwave is doing, right? So Interwave is actually a collaboration of Ernst & Young and Maersk and Accord, using the Accord standards, Microsoft, right? But this is a collection of people that are trying to solve one problem, which is insurance on ships. And it turns out that insurance is pretty complicated on ships because you buy the insurance sometimes just for one trip across the ocean. And the insurance rates can change based on the route that the ship is taking, what the weather is like. And so it's a pretty fluid type of insurance. And so Interwave actually used blockchain to be able to memorialize the policies, change the policies on the fly, so that all people involved in that chain are able to see what's going on with that insurance policy. So just an interesting example from the insurance industry. In healthcare, we have always known, a lot of us that kind of look out into the future, that one of the biggest things that we need blockchain to be able to do is to help with electronic health records. And so a lot of us have wished or hoped that electronic health records would move a lot faster. This could be such a improvement for patient outcomes. EHR has been a problem because, which standard do we go with? Which company, is trying to set up and control the EHRs? A lot have tried. The answer to this is you really need blockchain to sit underneath EHRs inside of a country. And so there is an example called Medical Chain that is in the UK. And this was actually built by doctors who, once they learned how to use blockchain to be able to track EHRs within a healthcare system, they actually went on during COVID and created a website called My Clinic, which used blockchain to be able to track information on COVID patients. And so, we love to see the fact that, all right, in healthcare, with a pretty complicated piece of data, the EHR, that blockchain is really helping. If I'm in the financial services space, I should take comfort in the fact that if we can sort it out with the EHR and healthcare, then we should be able to do things in the financial space. Or here's one that's kind of just an interesting one, not a lot of people are familiar with. The Theta Network might be an interesting one for you to look up. Now, the Theta Network is trying to do decentralized video delivery. So essentially, they're trying to replace or augment what YouTube is doing in the world. And so they're actually using blockchain to memorialize who is in the Theta Network, be able to use some of the extra processing power that's sitting on computers and use it to push video. And it actually tracks who is supporting the delivery of video and gives rewards, all based on a blockchain network. So again, if you've never heard of the Theta Network, it's just a really interesting use of blockchain to be able to support what might be a new generation of video delivery after somebody like a YouTube, which does not require building huge data centers everywhere. Or the last one that I'll share with you is just real estate. And there were two of them that I kind of find interesting in the real estate world. So you've got Deedcoin, which is actually trying to figure out how to use blockchain, or they have figured out how to use blockchain to create a different type of transaction between realtors and buyers. And so that's one. And then Ubiquity is basically a software as a service using blockchain to try to be able to help with the actual closing documents and memorializing all of the closing documents. Right now, almost all of us have bought homes. If you have bought a home, the closing and all of the documents are somewhere stuck between right now being physical and electronic. And so, Ubiquity is trying to move more and more with a blockchain-based closing system to memorialize everything electronically so that we're not having to write it down in big red books in a county office anymore. So I share these because they're just interesting examples from different industries of what's going on right now with people using the blockchain platform. I want you to take away from this that it is something that it's getting up into that plateau of productivity. We can trust blockchains to be able to safely, securely, in a decentralized way, memorialize a lot of any type of transaction or any set of data or agreement or asset class. All right, I'll just finish up because again, we're future point of view. And so, our job is always to make sure we're looking forward. 4 things I would tell you about blockchain. 2 good things, 2 things we got to watch out for. On the good side, we have more and more blockchain platforms being built and supplied. You have companies like Amazon supplying a blockchain platform that you can just go rent. Well, that makes it easier and easier to assemble an underlying platform. You're going to hear Sanjay and his people talk more and more about platforms that are being built to be able to monetize assets, right? And so we see more and more underlying platforms being built, and that's a great thing. We see more and more of these platforms becoming industry utilities. So in other words, not just building a platform where there's 10 different platforms doing the same thing, but building a platform where there is one platform that does one specific thing in an industry. In other words, platforms becoming industry utilities that everybody can share and everybody can use. And there's huge benefits to everybody being able to share and use these industry utilities. Now, on the risk side that we need to be careful about, anytime a platform grows, it also becomes under more attack. One of the lovely things about blockchain is that it's very difficult to defraud or to attack, but we have to be, we have to be cognizant that as blockchain platforms grow, as there are billions of dollars trafficked over the blockchain platforms, they will come under increasing types of attack. So it's just something that we will always have to watch out for. And then the other thing that we're going to need to really watch is the uneven adoption internationally. So there are some countries like Russia and India that are doing very well with blockchain as an underlying platform. And then there are some countries that have almost no expertise at all in these platforms. And so this is one of the things we'll wrestle with for the next 10 to 20 years is just uneven adoption across countries around the world. So that's kind of my just 4 things to just watch out for as we look forward. But I would just close this with, from now on, for the rest of the session that Sanjay has put together, when you hear any organization say, hey, we're building on top of a blockchain foundation, I just want you to not hesitate in understanding that this is not a platform that's going to go away. This is a platform now that is getting up into that plateau of productivity. They work, they are secure, they are decentralized, they have advantages over the systems that we use today to be able to memorialize any type of transaction. All right, so Sanjay, I'll stop there and I'll kick it to Mark, I think.
Thank you, Scott, and appreciate your kind remarks and you are having COVID right now. Best wishes for healthy recovery. I think you hit on the chain aspects very effectively. I think what we will see also in the following session, the 2 use cases of valuation as a service by Invenium and the supply chain financing by TallyX, is how to intelligently use it in the chain so that you don't have scalability issues and everything else in a DeFi environment. And I think that will be of real help. Those are the 2 powerful use cases that actually can furnish us to what Kelly is saying, how private markets are taking longer to go public. But the question is, if they have liquidity and valuation underneath it, do they need to go public at all, right? If you can create liquidity events. So Thank you, Scott, so much.
Exactly.
Appreciate it, Scott, so much. Mark, I will turn it over to you. Do you want me to do your presentation or you have it?
Yeah,
Mark,
please go ahead and put the presentation up, Sanjay. Thank you.
I will
And
do that
thank you, everyone, for inviting me to be involved in the conference. I'm deeply honored. As Sanjay said, I've been in private equity for over 25 years, worked for 3 investment banks. I founded the private equity business at UBS back in the late 90s and have been privileged to work with about 250 different general partners to raise over $300 billion in alternatives with my team and I. So very thankful for the experience I've had. My engagement has been primarily with institutional pools of capital, and that being really pension funds, endowments, foundations, sovereign wealth funds, and insurance companies as being the larger investors in private markets. If you go to the next slide, Sanjay, there are a couple points that I want to try to make as part of my presentation, and I'll be brief. But go back one slide. Slide 3 gives you some of the key themes. Why has private equity grown with such a robust fashion in the last 15 or 20 years? And I would say a lot of it's due to the fact that investors, pension funds especially, and people that have liabilities going out into long term in the future have been challenged getting the returns that they needed on an actuarial basis through public markets. So private equity, as it was established, really anywhere from with Warburg Pincus in 1966 all the way through to KKR in 76, Blackstone in 1985. But these firms were really the pioneers in the asset class, creating opportunities to buy companies in a private format in an illiquid structure, and to be able to grow those companies usually through operational input, working with management, and then sell them typically in somewhere between 3 to 7 years. But that being really primarily the buyout type, more mature parts of private equity, not so much the venture world that Kelly was speaking of earlier. So if you look at a couple of these themes here, I'll run through them quickly. But again, private equity has been now adopted widely by pretty much every large institutional investor around the globe. The percentages, though, are still relatively low, between 5 and 15%. If you're a pension fund, if you're an endowment foundation, and very illiquid centric, it might be up to 30 to 35%. But private equity in total today is about $4.5 trillion in value in the entire asset class. To give you a sense for the size of that, the global bond market is worth about $105 trillion. Public equities, the size of the market is about $95 trillion. So private equity is still a relatively very small part of the overall financial environment that we live with on a global basis. But as the scale of capital has increased, more efficiency happens in the marketplace, and therefore, returns correlate to that. What does that mean? Is that returns come down, because as bullet point 3 states, many of the largest private equity firms are the ones raising 50% of the capital. And so these large firms, i.e. Blackstone, Apollo, TPG, Carlyle, all of these folks have very, very widely efficient platforms that are seeking opportunities, but the opportunities are also now marketed by investment banks that run very efficient auctions to ensure they get the highest price possible for their company. And as bullet 4 says, with inexpensive debt today playing into the model of returns, general partners, have thrived and are now paying prices, though, in these competed auctions, somewhere 10 to 12 times plus. And these are for mature companies where you're trading off a trailing 12 months EBITDA. So as you think about, private equity's inefficiencies, much of that, is eroding as you get more and more efficiency and capital into the marketplace. I would say, if you go back just one slide real quick, Sanjay. So as you think about, this efficient marketplace, though, at 10 to 12 times, the S&P is trading at 22 times. So there still is an arbitrage between the private and the public markets from a return basis. Information flow for private assets, though, is still extremely slow and inefficient, and that has to be solved, as bullet point 6 states, for this to become now a much more robust asset class where you have defined contribution plans like 401ks, as well as this becoming a much bigger part of institutional portfolios. Okay, next slide. So if you look at North America just as a proxy, and I'll show some data here in a second for Europe and Asia as well, but you can see here when you think about the capital overhang, the amount of dry powder on the sidelines today is about $1.4 trillion, in the North American marketplace. You also see the size of fund at the bottom, those scales, and much of it is really in the hands of larger, more sophisticated general partners. Next slide. So as we look at the North American overhang, the remaining dry powder versus total value, again, you see about, just in North America, though, it represents about $3.3 trillion of the $4.5 trillion global market. Next slide, Sanjay. As you contemplate, though, and looking at the distribution cycle, so this slide shows you capital calls versus distributions for the investors. So as you can tell, from about 2012 until 2017-18, there was a tremendous amount of liquidity coming into the private equity marketplace as more capital was raised. In many cases, we had secondary private transactions, i.e. a private equity firm selling to another private equity firm. And the distributions were very robust, very strong returns. And obviously, this is also coming off of the Lehman crisis in 2008, when a lot of asset prices were low and general partners are able to make tremendous returns for investors. Next slide. As you think about, therefore, the size by bucket, so, how long a fund has been running, when the final close of the fund dictates the vintage year that fund is dictated or named by in nomenclature. And so here you see that there's still a tremendous amount of capital in some of the older funds, though. And it comes back to Kelly's point that the average holding period has been extended. In buyouts now, the average holding period is 6 to 7 years, where that used to be 4 to 5 years. So it takes longer for general partners to generate the kind of return profile that they would like for their LPs. Next slide. As you think about Asia is a rapidly growing private capital marketplace, whether it be from sovereign wealth funds or from insurance companies or high net worth family offices. It is the fastest growing market by far in private capital, and will continue to do so. As you think about, many of the great companies have been built, whether it be Alibaba, obviously has had a tremendous impact, across the globe. Next slide. As you think about the European marketplace, Europe was early in private equity, but it didn't grow quite as fast. And candidly, the pools of capital are smaller than North America, but it continues to grow rapidly as well as those investors search for additional returns and yield from whether it be private equity, infrastructure, real assets, or private credit, which has now taken the place for many investors from their fixed income allocations they had because interest rates are so low. Next slide. So, as you think about the result of this with Invenium, and Pat O'Meara is going to give you a better overall profile of Invenium, but we do believe that candidly being able to provide readily accessible data in a more robust fashion to investors will allow them to get more capital invested into private asset markets, whether it be private equity or private real estate. And to that end, we're excited about the future. Sanjay?
Yeah, thank you so much, Mark. I must say that the data that Mark presented, he has been working on it for 4 or 5 days, and a lot of that is private and sourced by him. It is not publicly available data. So I think that makes the case. Mark also touched on the point of defined contribution, defined benefit plan coming into private equities, provided they can get transparency on the underlying valuation. And one of the fastest growing asset classes is CITs, common investment trusts, and they are targeted date funds. And they are now considering whether they can do investments into private equity. And the one thing that is falling apart right now with the government is not allowing is the regulators are saying, if there's transparency on the underlying valuation of that asset, then common investment trusts and defined contribution plan and defined benefit plans can invest in it. So for global listeners, these are like your pension plans, and these are terminology we're using for North America, but these are your pension plans and everything else. So if those inflows happen in the marketplace, you can think about what it will drive to the valuation of private equity and how much more money will be available for startup companies. Thank you, Mark, so much. This was very well. And I've known Mark only for a short time, but every day I've learned from him. And I thought I knew about the institutional marketplace, but I think he's written a new book in my chapter as to what it is and what it is not. Thank you so much. I think just following, and thank you for taking that, and thank you for allowing Scott to go earlier, Mark. Really appreciate it. David, it's yours now. I think, we talked about blockchain, we talked about private market. We want to get your aspect of what the acceptances and challenges are, and understand how do regulators look at it. David, you may be on mute. David, you're on mute.
Okay, it took me a while. I had to get back into it. So give me a second, and I'll pull up the is it okay? Is the presentation on?
Yes, we can see your slides.
Okay, can you see it? Terrific. Okay. Look, I wanted to just say a couple of things going back to Kelly Rodriguez's patient, and I'm going to speak pretty quickly because he scheduled me for 10 minutes after he told me I had 15. So, Sanjay, I've known Sanjay for a long time. We're good friends all over it.
David, you can take 15 minutes.
Okay. But I was going to just say, I wanted to point out some of the things that are broadly going on in the private market for a second. And I know a little bit take issue because of the Jobs Act with some of the things that Kelly said. I mean, people aren't going public at earlier stages because the stock market just doesn't work to take them public and to support them. They went to an all electronic market structure, dropped the bottom out. One of the things that we did in the Jobs Act, which actually enabled a lot of the unicorn phenomena, is that, and we call it sort of the Facebook effect, is we moved the number of shareholders from a cap of 500 in private markets up to 2,000. And that has pretty profound implications for allowing people to stay private, just FYI. That was sort of, that, and that's one of the things that's generally not understood, but also the ability to get out there and market more broadly in private and public markets pre-IPO with testing the waters and general solicitation and some of the other changes that have ultimately been brought into the entire by entire market. If you electoral to enable some of this activity that we're seeing in private markets, we see ourselves wielding Co as a 4.0 business model, if you will, but it's a very different than, we're not a blockchain company. We are a distributed in the cloud investment bank with 100 professionals, and we're going to 1,000 over the next 5 years. We think that the human capital and the kicking the tires and everything's absolutely critical. Most of our business is in private markets. We're now in 17 states, the District of Columbia. We got one in Europe, and one in Singapore right now. We attract, and there's a lot of ageism on Wall Street. We attract a lot of very senior professionals. We got folks from Goldman and Morgan, I mean, you name it, and pretty high quality folks. I ran a top 10 investment bank, and the thought is that we can ultimately replicate a lot of the capabilities of bigger in the cloud. We are doing private secondary transactions, SPVs into private company stocks, private placement, M&A. We work on blockchain companies and currently working with Invenium. We sit on the board of I sit on the board of INX, which was the first SEC approved token for an operating company. It took 2.5 years to get through the SEC. NASDAQ and the NYSE was not ready to list a token, double F. Why is that a problem? Because it throws you into blue sky hell. Now you got to try and convince or articulate and explain what a token is as a security to all these state regulators, and it creates incremental cost. It's sort of like, the pioneers are sometimes getting arrows in their back, and that's a little bit of, what happens, just enormous cost. But we did plow through, and DTCC, which is a trust. Remember, if I could get a token to trade a security deposited at Depository Trust Company, then it could be shown on in the accounts of retail investors at Morgan Stanley, at UBS. It gets into the system and broadens the market. And so these are all kinds of gating items that right now still have to be plowed through and fixed, because I mean, if you look at it, I'd say that less than 10% of the total universe of investors have cyber wallets and can even buy a token as a security or a cryptocurrency for that matter. That if you know Jeffrey Clark's book, Crossing the Chasm, you know, we still have not crossed the chasm into sort of broad ownership of any form of token. You know, liquidity, I wanted to talk about for a second, but it can be a false promise and a false benefit and lead to losses. And in point of fact, and that means you got to get these securities or tokens or whatever they are supported. And is the liquidity instantaneous or continuous? Is it at an acceptable price? I mean, because if your price declines as an issuer, you know, it undermines your access to capital, it harms employee morale, harms customer perceptions, harms financial institution perceptions of your company, it harms investor perceptions. So making sure that that valuation is sustained on some level is critically important. And so that at least in earlier stage companies, and this goes back to I think what Mr. Bourgeois was saying, is that you need information, and information historically was provided in public markets by active research support, active sales support, salesmen going out and telling the story, active market making. And so all of these kinds of information inputs are critical. It's one of the things that Invenium is providing in private markets is form of information we think will be very healthy to ultimately driving the entire ecosystem for private security valuations and ultimately trading. I put this little sort of chart together, but innately large capitalization securities can be in the upper right-hand quadrant can be very, very innately liquid, right? And so what we did with hyper electronic efficient markets is we made innately liquid securities, S&P 500 securities, even more liquid. And in the lower left-hand quadrant, these are the things that really require heavy lifting, but are so important to the innovation economy, which are the earlier stage companies that don't have information supports and don't have market making. We obliterated a lot of the ecosystem to make these markets and provide research on micro cap stocks when we collapsed trading. So one of the things you're seeing in public markets is that by dropping the bottom out of support, because there's no longer an economic model to pick up the phone and sell it, find a buyer to offset a seller in these micro cap stocks, what academics call asymmetric order book securities, big seller, no buyer. We created effectively a bridge into an abyss when you go public for smaller capitalization companies. And so the market is acting very logically, which is that companies, as Kelly pointed out, the gestation periods of companies has gone to 12 years. He said it used to be 6 years. I would say that if you go back to the 1990s, during the dot-com bubble, companies were going public in 4 years or sometimes less, right? So this is really a market structure problem. And so the question is, can we solve it in private markets? Yes, we probably can. Can we ultimately solve it by changing public market structure for smaller capitalization stocks? We actually had a big bill to create a new form of venture exchange that got through the House 406-4 in the 2018 Congress. And it was supposed to have gotten passed into law, but when Trump shut down the government over the wall, it had the effect of mooting the legislation when it pushed it into 2019. Interestingly, the chief of the transition team for the Biden administration gave a speech on the floor of the U.S. Senate, saying that if we can get the $25 million IPO to work again, both on the offering and in the aftermarket, we'll get America back into business. And so, whether we can do it in private or public markets, preferably both. I mean, the fact of the matter is that there's a lot of intellectual capital being devoted to solving these problems and to making it better. And I think it's probably one of the most exciting spaces in the economy right now to be a participant in. That's all I have to say. Sanjay.
David, so David, do you see? I mean, sorry, do you want to reduce the share? I think you're still sharing. Thanks.
There you go.
Appreciate it. So I think, David, thank you so much for it, and it gives us a good perspective of rounding up what we had said before. But and Pat is going to cover it to some extent. But talk about tokenization of asset as opposed to asset tokenization, right? We are talking about the SEC is very worried about certain aspects that when you're trying to do an asset and you can't back it, and there's no when you're trying to tokenize something and there's no asset underneath it, they get very furious about it, and you start putting all the aspects about that asset on a smart contract, which is not legible. They get very upset about it. So I think the aspect of what do you think will be when tokenization of a physical asset or an asset like a private equity, private debt, how would SEC respond to that?
Well, first of all, the SEC does not, they let private markets do what private markets want to do as long as they don't violate, securities. These are exempt transactions. Okay, that's the first thing to understand. So there's a little bit more of a blank canvas for people to color there, as long as they avail themselves of an exemption from registration. And that's one of the reasons why it makes it easier. It's also an accredited investor or institutional marketplace, so there's a little bit of caveat emptor. I think having gone through the INX experience with the SEC is that they're acting very predictably with the public. They just want to make sure that nothing blows up. Kind of the first parable is do no harm. And so they're looking for all of the protections that people are afforded in public markets to be brought into tokenized assets in public markets, right? They're not looking to stop it. And in fact, Jay Clayton has said that, he thinks that there could be a future where all stocks or all public securities are traded as tokens. But we still have an institutional custody problem, for instance, that needs to be solved. Transfer agent, issues and what happens if somebody loses a token? Is there a mechanism for that to get potentially replaced? I mean, these are all questions that the SEC, I think, is rightly asking to protect individual investors in public markets.
Thank you so much, David. So I think this is a good follow-up to Patrick O'Mara, who's the CEO of Invenium. I think what Invenium has done in this space is tremendous, and it's his first use case. And I think he will cover the aspect of what Invenium is, but he'll also cover the aspect of the use case of valuation as a service that can inform the performance of any asset underneath it, right? So that people can really understand that asset and put a price to it. So with that, I turn it over to you, Patrick.
Hey, Sanjay, thanks so much. It's good to be with you and all of those in the audience, as well as all these other speakers. David, great to hear from you and your wisdom, particularly as the public markets have evolved and in many ways orphaned those smaller companies, right? Taking the bottom out, cease to support them. And I think part of what Invenium is doing is filling in that gap, and particularly as it relates to the data gap that exists between the public and the private markets. And as the public markets have an Edgar database and there's public filings required for data, there is that information as an oracle provides opportunity for investors to be informed and their consequences if the data is incorrect. So as we move forward in a global data economy where people are on private companies, they are not trusting third parties to maintain their data with integrity, and they are owning their own data. So how do you credential that data over time? And that's fundamentally what Invenium is doing. We are credentialing data on a distributed data global database or data economy, excuse me. And so specifically what we're doing is moving to data and transparency on private markets. So it is on demand, permissioned access to data that has been credentialed where the data was created at its original place of rest where it's being credentialed. And what we're doing is, I want you to think of it a little bit like Refinitiv, except for private markets, right? So what can we do? Using very basic robotic process automation, and I'll talk through that in a minute, we can facilitate how we do that. With that, we can facilitate the ability for data to be evergreen and observable at all points. So what are we doing? We're literally using this RPA on a daily, weekly, monthly, quarterly basis, going in and digitally certifying that data so that the completeness of the data is immutable, and it's anchored into a cryptographically secure ledger. That can be a public ledger, it can be an enterprise ledger, it can be a quantum ledger with the Amazon's quantum ledger with a single node, Amazon, or it can be a metachain on a company's own databases, meaning cryptographically secure Merkle tree that they're anchoring into it. So like kind of blockchain on training wheels. And what we're doing is we are time stamping that data, putting a hash that every time that data is opened again, you match that to ensure that it hasn't been altered in any way, shape, or form. Then once it's indexed, fielded, we can begin the process of validation and providing mechanism for proof of truth of that data. Once that's done, that data at its place of rest has all of that credentialing, but it's not public. And what they can do is, again, on demand, provide credentialed access to that private data. And so what you're doing is you can create a mechanism for trusted private data around the operations of an asset. Think of a commercial office building, think of a private equity asset, tough for venture capital where there's so much qualitative. But when you're looking at data-rich, low-frequency trading assets, and you can begin to feed that trusted data into tools, and those tools can be risk management tools, they can be investment calculation tools, but we think the killer app for blockchain, and particularly in the private markets where they're gonna adopt blockchain, is around valuation as a service. And this is to facilitate price discovery in these markets. And so we're gonna have verified and high functioning data that's gonna be used in multiple tools, right? So what does that look like for real estate? Let's use that as a specific example. We can take an asset and we can digitally certify the data that's coming out of that asset, right? Just running an algorithm, coming up with a hash. Every time somebody over time wants to look at that, we can make sure those hashes match to ensure that it's a digital notarization, but it hasn't been altered in any way, shape, or form. Then we can field that data, right? Then we index it, then we field it according to international standards. We validate it, we can push it into tool sets, and then we can start to relate it to other data sets. And this is going to provide public market-like performance delivered real time on pricing and data. So right now, today, we can start to price a commercial real estate office building in New York on a monthly basis. It's a US PAP compliant price, which means a public company can use it as a mark in their books. It's a FARIA compliant price, which means a bank can lend against it. We've been pricing these types of assets since March of this year, after 4.5 years of development with our software, getting to the point with partners like Cushman & Wakefield, who's providing the monthly price, with Deloitte, who's also validating that that asset, because of the observability of the inputs, we're moving that asset from level 3, an illiquid asset, to a level 2, a marketable alternative. And if the management team, looking at the comps that Cushman has delivered, the sophisticated model, and the observability of the inputs, and the management team then says, yeah, this is going to be a mark that we use, we literally have the ability to move that from a level 3 to a 2. And if the management team does that, Deloitte will concur with that. We've been working with Deloitte for about 2.5 years, getting them to that point. As you know, when that happened with high yield bonds, when they went from a 3 to a 2, it radically expanded the world of who could own those bonds by policy or by regulation. And when that happened, an enormous amount of money went in. Trading flowed into those assets dramatically. And what we're going to see is individual assets are going to be able to be held in a better manner on people's balance sheets. And so what we do is we're working with an ecosystem, validating data, going back and forth between asset owners, CRE tech providers, valuation appraisals, people who are providing comparative data and analysis, as well as custodians. And these custodians are particularly beginning to offer valuations of service to general partners at the behest of the largest of the large limited partners, where a limited partner who's investing in a fund can get a third-party mark from their general partner. And what we're doing is we're delivering transparency, immutability, auditability. right? And this price discovery functionality where we're using robotic process automation on a daily, weekly, monthly, quarterly basis, where we're pulling the data, credentialing it, pushing it in a tool in a just-in-time basis. So it doesn't need to reside in the tool like in an Investran that, as you know, gets very unstable over time, but it's a just-in-time delivery into the data. We get the output, everything has an audit trail completely, and we see a number that comes out and it changes the carrying cost of that asset, particularly when you have regulated capital like an insurance company. We'll talk about banks in a minute and what that does. And what we want to say is that we are seeing very, very large asset owners desiring third-party marks inside their books so that they can get better data on their portfolio, but as well, their fiduciary duty is being met. An example would be New York Times wrote an article about CalPERS saying they want to allocate more to private equity, but they can't get there because they don't have data. This is a mechanism to solve the data part where we're solving privacy at the same time. And what we're doing is we're pulling data in from CRE systems that are paid systems, their market data systems, their tenant systems, as well as asset systems themselves. So I want you to think of CMMS, computerized maintenance and management systems, building information management systems, property management systems, where literally we have a data room with no data in it, but rather pointers and hashes to where that data sits in 1, 2, 3, 11 data systems. And that data room is evergreen. And if any of the data is moved or altered, we'll know immediately the next time somebody tries to access that data. And so what we're doing is we're getting a mechanism to not only credential that data, but also the ability to relate that data to other data sources in order to drive a probability, a deterministic probability of the truth of the performance of those types of assets. And so that's what we do. And we have a phenomenal team here. Sanjay Vatsa is our Chief Revenue Officer. He's on our, also chair of our advisory board. Mark, who you heard from earlier. We've got a number of superstars on our team. We've got about a 60-person team working for 4.5 years, and we're now delivering a product. And we're going live. We are live with some clients. We're going live with a number of Fortune 100s and with some of the largest asset owners globally. And what we are doing is bringing this expertise in order to solve a real problem today using the newest technology of the blockchain, where it is being used not as a database, not as a middleware, because it's not appropriately designed for either, but as a mechanism to commute trust. And what we're not commuting trust on is ownership of an asset. We're commuting trust on the provenance of the data. And as you know, if you can trust the data, you have the ability to execute trades. Because right now, a real estate trade, if I want to buy a building in downtown London, I put in a bid, I've got 120 days. I do due diligence on, structural engineering, mechanical engineering, electrical, hazardous materials reports, all of those types of things that my bid is subject to. When we can begin to stipulate those performance metrics on the asset, we can then focus on bid and ask only. And when we can focus on bid ask only and all the performance attributes of the asset are stipulated, those assets will start to clear. We think we're literally a few years away from real estate assets starting to clear in 2 to 5 days. And eventually those real estate assets will clear same day. And the way that'll happen is if the building owner can have a comparative analytics without a loss of data, meaning data leakage, with the buildings around them, and those are called zero knowledge proofs. And we're going beyond what are called ZK SNARKs, or these succinct, non-interactive arguments of knowledge, to ZK raised or random anonymized interactions with specific data sets. So a higher functioning zero knowledge proof where we can interact with data. There's no data leakage, but you can see how your building's performing across KPIs against not only the local buildings, but also against a prospective buyer's current portfolio of assets. And that's what Invenium is facilitating. As we do this, and we can see comparative performance, and we can get third-party marks from the likes of Deloitte or Cushman & Wakefield or other firms that are in here. We're an open architecture. We want to be able to push data to lots of different valuation firms. but Cushman & Wakefield and Deloitte have been fantastic partners for the last several years, investing with us in delivering this process and the ability to move a real estate asset from level 3 to level 2. And just to give you a sense of that, what does that mean? We can literally move a real estate asset that has, for an insurance company that has an asset, a real estate asset on Schedule BA, and they have 20% capital reserves, we can move that to Schedule A, which is a 10% capital reserve. So we're literally reducing by 50% the capital reserves of an insurance company, and Deloitte will prepare the documentation for the schedule change for NAIC in the United States. For a bank, we can dramatically impact their Tier 2 capital for the assets that they own and operate, that the delta between where they hold it at book minus accumulated depreciation and the fair market value mark that we're delivering is additive to your Tier 2 capital, which changes value at risk and capital at risk. Better data on data-rich, low-frequency assets that has an audit trail provided to it can change the holding cost of real assets. And that's what Invenium's doing. And this is going to transform it because the ability to commute trust on data is just as meaningful, if not more meaningful, than commuting trust for immediate settlement of ownership of an asset. And that's what we're focused on. And Sanjay, we really appreciate you giving us some time here. And I'm excited to have been a part of your panel. Thanks so much, brother. Sanjay, you're on mute, my friend.
So Invenium, that's it. I made the silly error of staying on mute. So thank you for pointing it out, Patrick. So I think what Invenium has done is a disruptive platform for the next generation for private assets and everything else. It's the underlying platform that will feed data to any private asset and inform that asset about the performance of that asset. And I think, what Patrick did not mention is that we have already done valuation on a couple of real estate assets. We can show you how the change in value happens every 3-4 months. And because of COVID situations, the traffic has gone down. As a result, it has affected the valuation. But this is the future. This is the future. This is not the past. And I think the way Invenium has cleverly leveraged blockchain and avoid all the pitfalls of blockchain, which Scott talked about, is very encouraging. So with this, I'll turn it over. That's the first use case. I think the other use case I want to turn on to is, I want to turn it over to Aditya and Daniel, is on supply chain financing. Now, this requires no valuation. You know what the person owes you as a money, but how do you tokenize? How do you do deep tier supply chain financing? And how do you actually get financial inclusivity in this place? So I'll turn it over to Aditya, who is the CEO, and Daniel, who is an advisor to TallyX, but also is very, very instrumental in the supply chain financing in globally.
Thank you, Sanjay.
Over to you.
Thanks, Sanjay. And it's my pleasure to speak to you today along with Daniel. We're going to take kind of two hats. So I'm going to have Daniel speak more about the business and rationale behind why something like this makes sense. While I'll focus on some of the solutioning of this. But just to set the backdrop, it's important to look at this from a global macroeconomic perspective. So if you look at the WTO report from a couple of years ago, really what it's saying is that, first of all, there are a huge section of global trade today that goes under or unfinanced, or at least not financed through, I would say, regular banking or other channels, but perhaps through shadow banking and through other means. The first is the commercial service exports growing at 6%. Banks basically, I think, have blinkers on. They only look at what they think is their addressable market, which is why they claim the trade finance gap to be 1.5 trillion. However, the real funding gap is about 5 trillion. As you can see, there's a 10 trillion gap demand for 30 to 120 days working capital, and the real gap is about 5 trillion. 60% of suppliers today go unfinanced. So clearly, there's a problem to solve. I'm going to hand over to Daniel to talk about why blockchain and perhaps why blockchain in trade finance. Over to you, Daniel.
Thank you very much. First of all, I think it's been a fascinating panel to date. So Sanjay, thank you for assembling. I certainly learned a lot, even in the last 2 hours. So very, very interesting. And it's a pleasure to be speaking with you all. As Aditya mentioned, obviously GLT or blockchain in trade finance has been around for a while, but why is that so important, particularly in trade finance? Fundamentally, it's a question of trust. Trade finance, by definition, is a set of transactions that involves a massive number of different parties and different transactions. So, as a good example, Maersk did a case study a few years ago where a single container of avocados and flowers went from Mombasa in Kenya to Rotterdam, and it involved 30 different parties, 100 individual people doing over 200 different transactions or communications. Now, think of the complexity of different documents and different communications going on between all of them. That presents a fundamental problem of trust, fraud, mistakes, willing or unwilling. And therefore, if it was possible to create a single framework to operate across all of that, that would solve everything. Now, the old-fashioned way, before technology came along, would be a centralized repository, and we see those solutions again and again. SWIFT is the most obvious example, a central repository to which all of the participants, say the banks and now increasingly non-bank institutions, have signed up to use their standards. But that is a major difficulty to get all the parties involved, i.e. the 30 parties, the 100 people agreeing to a set of standards of how to communicate. So the next step, where the first step of GLT, and Aditya will talk about the next steps of GLT after this, but the first step is just to say, okay, we don't need to agree on a central repository, we just need to agree on a standard for communicating and a standard to engender trust. And that really where the thesis of GLT comes into trade finance in particular. And it has been already applied. I was very heartened to see in the previous presentation some very clear examples of GLT being used in real life and being scaled. In trade finance, we have a slide, the next slide, I believe, where there are a number of consortia, a number of different groups that are working to implement and scale GLT blockchain solutions in trade finance. And Aditya is well placed to talk about that because he's been at the coalface for a very long time. So over to you, Aditya.
Thank you, Daniel. As we look at the trade finance consortia, and these are just a sampling. There's probably another 6 or 7 of them which are starting to have scale. You've got the Singapore Government Consortium, the Hong Kong Trade Consortium, etc. What we're seeing here is a couple of observations, right? A number of these are 3 to 5 years old. The only ones that are really scaling right now are Comgo. And Comgo, actually, interestingly, is not scaling for the actual commodity trade finance piece of it, which is the mainstay of Comgo, but really for solving a very specific problem of post-trade settlement or bringing efficiency to post-trade settlement. In terms of the Thailand blockchain consortium, I would say is the only consortium that's really rocking, and they're working on digitizing a very specific use case, which is standby letters of credit and bank guarantees. And those are for domestic transactions in Thailand. There are about 14 plus banks and a satellite of about 30 banks who are part of that consortium. And they're doing a real volume of business in Thailand today. I would say some of the reasons why the consortium model is struggling is because a lot of them are focused on digitization of LC. To Daniel's earlier point, you need 22,000 banks, 150,000 people involved in the shipping and logistics around the world to all sign up for this new version of truth for it to work. And so that's a pretty tall order. The second thing is that if you look at the names on this, you'll see, with the exception of Comgo, where you actually have a lot of corporates at the table, you have, they basically be run by banks and for banks. We think that for this to work, you really need a decentralized ecosystem that allows blockchain, the benefit of blockchain, essentially to cater to the key stakeholders who are corporates at the end of the day. So corporates need to have a seat at the table. and to be able to freely operate their own ecosystems. If you look at the slide from Gartner, just putting a little context to what Daniel said earlier, we're in an evolution. And what we're seeing with some of the consortium is really tackling the first two parts of that evolution. We're looking at electronic things, which actually represents the goods or services being traded. And today, we at Talix are focused on building what we call smart things in anticipation for a future, which will be autonomous things. And the difference is, even in blockchain, you have different shades of gray. So it's one thing to use a distributed ledger to record information. It's another thing to actually to tokenize assets. So you've heard about asset tokenization in the earlier sessions. We're focusing on simply digitizing and tokenizing anything that's being bought and sold, either on a retail or on a wholesale basis. So if you look at this today, we see an evolution in terms of the model. Today, we actually are very much in an open cloud model, but tomorrow, we believe that it'll be open and decentralized, where essentially industries can create their own private implementations of either public or semi-public chains, which are interoperable, and we see that as really being the future. Coming a little bit back to the business side of it, I'm just going to ask Daniel to comment about how DLTs has been currently been used to date, and what are some of the practical applications for blockchain, and particularly around tokenization.
Thanks, Aditya. And you made a good number of excellent points. Particularly, DLT can be used in a number of different ways, and I use blockchain and DLT interchangeably. In the consortia that we've mentioned, they have a number of different solutions, but really they all come down to the same point of reducing the level of mistrust. And really, it's about putting data onto a blockchain. And in the simplest applications, it's putting the invoices, the irrevocable payment undertakings, and data around that onto a ledger, so that all the parties to that can engage in reverse factoring, etc. So your classic standard supply chain financing. Where it gets much more interesting is what you and I have been working on, the next step, the next turn of the evolution of taking assets and actually tokenizing them. So instead of merely putting the data on and keeping the assets off the chain, the token becomes the irrevocable payment undertaking. And once you get to that stage, you're able to create, most excitingly, deep tier financing. So most people, when they think of supply chain financing, this is about 2 points between a buyer and their supplier. But actually, to the earlier slide, there is an entire supply chain, and it's really at the deep ends, at the far ends of the supply chain, where the biggest problems with liquidity, with access to capital lie. And it's enabling the pass-through of the credit worthiness of the end buyer all the way down the supply chain through deep tier financing using tokenization, i.e. creating a digital, trusted, fungible, and transferable digital representation of that initial invoice, of that payment undertaking, that enables those deep tier suppliers to get the liquidity that they need and to maintain the health of the entire supply chain. And that is exactly what we're working on right now in Saudi with some of the largest Saudi companies. So this is a real life example of the next turn of the evolution.
So just to delve a little bit deeper into the actual token. So first of all, we're trying to create a new digital trade standard, right? So we said, okay, let's try and align against some global emerging standards that are there. So a bunch of banks came together and created something called a digital obligation to pay standard. So we aligned against that standard. There's also the Accord project, which was mentioned in an earlier session today, looking at legal contracts or smart contracts. How do you take a legal contract and implement it in a smart contract? So insofar as purchase orders and invoice goes, the Accord project has basically got a working group that are looking at how to take existing purchase order and invoice information and the obligations that arise out of those contracts and put them on a blockchain smart contract. So what we've done actually, trade is a complex animal, right? You've got a large shipment, a large order, you can have partial shipments, partial payments, fractional finance, etc. So you need to have what we call a refungible token. So what we've done is we've created a new proposed standard in Ethereum called ERC 1513, which blends ERC 721, which is the non-fungible token, and combines it with a token registry of any fractional values that will arise out of that trade transaction in its life cycle. And we use ERC20 registries to record that value. Our trade token is not a cryptocurrency. You can certainly settle it using a cryptocurrency, but in and of itself, it's an information token that looks at the entire goods and services through the life cycle of what's being traded, and also lets investors get a view of what is the actual risk of that token. What is the underlying risk profile of the buyer, the seller, and the actual physical risk in terms of shipment, transshipment, and other information, container data that may come in during the process of a trade. In the case of services, your SLA information can be packaged into the token. So if you look at the use cases for tokenization, what tokenization does better in the market, we're really looking at 3 or 4 broad areas. The first is ability to take these trade assets and do portfolio-based financing. So it's not one-off, but you can bring a pool of assets together to finance them by creating a marketplace between investors and that particular pool using a private placement mechanism. The second is basically ability to do deep tier finance, which is how do you finance a supplier using a split token mechanism, where I can take a digital obligation to pay and split that successively to tier 2, tier 3, tier 4. The next is around syndication and risk participation. So once you have a pool of assets, then a natural extension is to bring multiple participants who want to basically invest in those assets or in the assets in their life cycle. And then finally, looking at contract performance obligation is basically how do you plug the value leakage in existing supply chains. We did a pilot for a large telco where we found a 5% value leakage in their 5.8 billion supply chain, procurement chain. So if you can plug value leakage using the token, that becomes an extremely valuable way of looking at it. I'm going to just hand it over back to Daniel to say, why corporates first, and why do we think that this approach is going to work better than perhaps the consortia or the bank-led approaches that we've seen over the last 400 years?
Yeah, thanks again, Aditya. And you really let me loose on the hobby horses. What I did before was build a digital corporate bank that's here in the UAE that really focused on supply chain financing and broader working capital solutions. So I have first-hand experience of what it is to get even a startup bank, a challenger bank, get working well in digital supply chain and getting other players in. As I mentioned, generally trade finance and trade requires dozens and dozens of different agents. So it's an incredibly difficult process to coordinate. And frankly, when you get banks together, that slows the process even further. And so from my personal experience, what is needed is to move away from a bank-centric model and to really move to a corporate-centric model, i.e. where you empower corporates to do more without their bank, because it's ultimately more in the corporate's interest once they realize what is possible of implementing such standards. And so having a powerful and flexible platform such as TaliX allows a corporate to really build and establish, seed, if you like, the hub and spokes model that you've heard before, where the corporate becomes the hub. And if it is large enough, then it essentially forces or encourages the rest of the participants in the spokes to come along for the standards necessary to make a supply chain finance and your supply chain management framework to work. And that's where the secret sauce is. By creating a framework for a corporate to be able to deploy and effectively use a supply chain financing, a supply chain management system, you get much faster results, as we're demonstrating right now in the Middle East.
Yeah, if you look at this slide, you'll see that what we're essentially doing is we're leveraging the buyer's investment grade credit, tokenizing approved payable portfolios, and using that to fund not just tier one, but allow tier one to fund tier two, three, and beyond. So today, there is about 85% trapped liquidity in the system, right? And if we can put that existing liquidity to good use, then essentially what we're doing is we're really benefiting the large anchors or even medium-sized anchors who have extended supply chains, both domestic and cross-border. In this particular example, we've taken a case study of the margin uplift that a corporate treasurer or a bank would get by actually engaging in deep tier finance using a tokenization model versus a traditional model. And as you can see from this, for $100 million financing over 60 days, we can create almost over 100% margin uplift for either the corporate treasury or for the bank itself. That's a complete game changer, especially in today's market where people are fighting for 50 and 60 bips margin, right?
And I would also add, obviously, there is a massive benefit for the suppliers of suppliers and the deeper chains of the suppliers, because they are getting access to liquidity that otherwise, particularly in today's world of disruption due to COVID and geopolitical situation, often they find themselves completely without access to bank funding.
So, Daniel, what do you believe are some of the, how do you quantify the benefits, and what do you think some of the key challenges will remain to get something like this out to market?
Well, I think Kelly made a very good point referring to Gartner's stages. I was surprised to see his assessment of the market acceptance is already at 3. Sometimes it feels like the market acceptance, maybe it's a regional thing, but I feel some of the regions are significantly behind. It's ultimately the mindset, because the technology is there, and we know that. TaliX demonstrates it, a number of other companies demonstrated, but the mindset of the corporates, particularly the decision makers, the boards, the C-suite, is not there yet. And if we go down the route of a bank-centric model or a bank-driven model, obviously the regulators and their acceptance of DLT, of the various standards and different offerings out there, will also remain a constraint right now. And that's really why I'm a firm believer in a corporate-centric model in particular. So apart from a mindset change, which we see happening right now, there are questions around scalability of technology, but those really are being answered as we speak. So I believe that it's fundamentally the mindset, and having these POCs, having consistent discussions and demonstrations to these corporates, to their suppliers, that this can work, will soon lead to much greater scaling.
Thank you, Daniel. I'd like to just close with our vision, saying that, look, if you look at the way supply chain finance is conducted today, you have multi-bank solutions, single bank solutions, in-house, ERP, treasury platforms, P2P platforms, all vying for this market. What's conspicuous by its absence is the fact that this should actually belong to the corporate. And all other players really are subservient to the actual corporates and their suppliers who are running this chain. So our real goal is to democratize this, decentralize it, hand control back to the stakeholders, ensure that we have a decentralized data provider for claims and assets. You saw a lot of this from the Invenium discussions, and we very much share that same vision. Important that the token actually is what gives you interoperability between these diverse marketplaces. Let 1,000 flowers bloom. Let there be thousands of marketplaces run by each corporate, but let's have an interoperable token to ensure that we can carry value and ascribe value, and then basically ensure that it carries through its logical conclusion. At the end of the day, we've created a set of building blocks, which include a token, a marketplace, network infrastructure, portals, global lien registries to reduce fraud, and a digital reputation on the blockchain, so that all the parties involved can get a much more transparent operating view of each other. We think bringing these together is what will make a difference. It's not just a concept of a single token and some shared code on Ethereum, but it's a value in building a set of building blocks that will enable the democratization of this entire process. With that, I want to hand over back to Sanjay. Thank you very much for this opportunity.
Thank you, Aditya, very much. If you want to stop sharing, appreciate it. So I think we are at the end of our session. We have received some questions, and Frank, are there a couple of questions we can ask someone? But in closing, I want to just say this, that, the two use cases you saw, one is valuation as a service that informs any private asset on the underlying data that can be trusted and evergreen at any point of time by cleverly using RPAs and blockchain as a means to an end, the end being trusted data that's highly observable and highly functional, is a use case that will actually revolutionize the private asset marketplace and make it more available for people to invest in it and have trust in the underlying price. What the second use case, which Daniel and Aditya so kindly shared with us, was on deep tier supply chain financing. This is a problem today. This is out of the 12 trillion outstanding on a daily basis, the banks pick up 6, 7, 8 trillion maximum. 4 trillion are picked up by money lenders who charge anywhere between 18 to 22%. This is pre-COVID days. Post-COVID days, who knows? I mean, they don't even get financing. And deep tier supply chain financing is this full tokenization platform that TallyX has built, enables a supply chain person sitting at the bottom to get their funding at a better rate. So they're better off because they can secure something at 5%. But the corporate is assured of two things. Not only they make procurement alpha, but they also can now look down the supply chain and make sure that nothing is getting disrupted because some component in the supply chain has been affected because they don't have money to finance their next set of orders for them. So I think these are disruptors coming, and I'm very pleased with the panel that they reflected on these things. And I appreciate all the time that they spent on us. So we're at the end of the session. Frank, is there one or two questions we could ask, or we should field the questions later on and answer it on a written basis?
There's a question that comes in. I think this would be a good question for Pat. And the question is, what types of private company assets can be tokenized faster, and how will trust get built with new data? Can digital certification be automated?
Okay. You want to take it first, Aditya, for TallyX? Because you're certainly doing the digitization on receivables.
Sure. My own sense is that today, particularly in a post-COVID scenario, the issue is ratings, right? Because in order to make that more freely tradable or freely financeable, it needs to be backed by ratings. So we think that the key to this whole game is actually a combination of blockchain tokenization and securitization. Because with securitization, you're able to take different classes of risk, do credit enhancement, and then offer them in an integrated offering, right? So that's one way to tackle it. If it's already a large anchor who's AAA rated, you don't need to do the credit enhancement. So the whole process of securitization basically will flow into either institutional or what I call private securitization, which then spreads the risk amongst, let's say, multiple anchors, multiple vendors, to create a marketable asset that's based on the rating. So I think the key game to be played as we go forward really is the convergence of blockchain tokenization and securitization.
And I think, Frank, I think Patrick had to drop off for another call. I think so. So I'll take it from Invenium perspective. So I think the tokenization, how fast they'll be tokenized, is all about the ecosystem, right? I concur what Aditya said, but if you really look at it, you're tokenizing an asset. But if we do not have information about that asset, what informs the performance of that asset, I can tokenize it, but it doesn't go anywhere. As you know, Invenium has tokenized 3 years ago, right? We have tokenized certain aspects of it. But I think what you're going to find now, because there'll be highly observable and highly functional data feeding into the private assets. Think about any private asset being in a data room, and we understand what kind of data is required to inform that asset, the performance of the asset, so the investor can perfect their ownership around it. That becomes the power. And that data coming in, it's evergreen at any point of time, will build confidence. Once it builds confidence, then the tokenization is a aspect of tokenizing. It's a matter of process and then distributing the token, right? But there's an underlying asset valuing it underneath it. So with that, I think we have come to a closure. First of all, I want to thank everyone. Dharti, I want to give you the last word as the president of TIE New York City and reflect your views. I didn't give you time up front because we had to run through it, and I cut short my presentation too. But Dharti, you're on mute.
Thank you, Sanjay. I really appreciate it. Thank you to this wonderful panel for accommodating us, staying with us, and I hope the audience got a lot of value. I certainly did. Thank you very much to you, Sanjay, for putting this together on behalf of TIE New York for TGS. Thank you to the Hyderabad team as well for putting this mammoth event together. I just want to say thank you. I don't want the next session to be late on our account.
No,
so
don't believe in that. Thank you. Thank you all for participating, and we'll have a recording of this session, which I'll send to you. Appreciate it.
Thanks. Bye-bye.
Thank you. Bye-bye.